All right. Good morning. Good morning, everybody. So yesterday, the market triggered into a technical bull market. Always love that. Uh, Historically, there are um, technical analysis signals that they can use for technical bear markets, technical bull markets. Um, and then, of course, there's always arguments from different analysts about whether it counts or why this time is different. But that was some of the news that I seen um, through stockcharts.com and Bloomberg, a couple others, that we were in a technical bull market. It doesn't change anything in the grand scheme of things. Everybody's still waiting on the Fed to announce a pause, and they're trying to be slick by announcing a skip, because there's anecdotal data that shows when the Fed does announce a pause, that there's a particular reaction out of the market, and the Fed's trying to avoid that reaction, but still accomplish the same thing, not raise next week. News this morning, GM is now joining with Ford on their adoption of using Tesla's charging ports. If you think about it in a way that makes sense, like your wall plug, your 110 outlet, it's a universal plug. It really doesn't matter what device you've got, from a toaster to a VCR or anything in between. It still plugs into your wall outlet. It's a universal. When it comes to these charging ports, if Ford does their own and Chevy does their own and Tesla does their own, then you don't have this universal port. And if now everybody is finally adopting one, and that will become the universal port, at some point, I believe the government will actually step in, and it'll just become this universal thing. Like right now, you can't decide to have a house plug that is not part of the government code of that 110 outlet, right? You can't design one with 7 holes and 2 grounding spots. And now whoever originally built those at some point lost it to the government, who said, we're just going to mandate it and make it a common standard for everybody. We have contract changes coming up on the ES. That's something to be aware of with different brokers. It may have already happened. On Thinkorswim, it will do it automatically for you. So when you're on the Thinkorswim platform and you just type in /ES, you're actually looking at a continuous contract and not a specific contract, because you didn't tell it that you wanted a specific contract. But if you look over to the side, it really is still reflecting the June contracts, right? Well, that's going to change, and very likely on Monday when we come in, it will be on the new contracts. So if you go into the chain here, across the top, you can see that the active contract has 7 days to go. You want to watch the volumes if you're not on Thinkorswim, say you're on Trade-Evade or Ninja, one of those others. You want to watch the volumes between the front contracts and the contracts in the next series out. Those would be the ESU or the NQU, right? It's the U series, the September series. When the Septembers have more average daily volume than the active current June series, that's when you're going to want to roll. What I did when I was newer and I wasn't quite sure if I should or shouldn't roll, I would roll when Thinkorswim rolls. All right, so on Monday, for an example, when you log into your Thinkorswim, that won't say June anymore. It'll say September. That means that Thinkorswim has rolled at that point. And so that's when I would roll, when I was a little unsure and not quite comfortable making that decision on my own. I would just do it whenever Thinkorswim did it. Now I just watch the volume and do it when the volume seems appropriate. All right, so we've got light volume and a market maker move, but there's really nothing on deck today, right? Labor force survey and quarterly services survey. These surveys, you know, it's a little bit of hit and miss. If we come over to the economic calendar on FX Street, we can see that Canada has some high impact. And then if we go to Finance Juice, we can see that there's the ECB speakers that we had talked about yesterday. I had warned, be aware and be prepared that today we were going to get a lot of speakers from the ECB, and that very likely could throw some shade across the market. And right now, between this data coming out of Canada and these speakers, it's got everybody sitting on the sidelines and it's got them hedging. So we can see that they're sitting out with the low volume. And we can see that they're hedging because we got a market maker move up here. It's also worth noting the narrow range that we have, other than the move through the kill zone, which really wasn't much of a move. But either way, we got into the kill zone, we had the move, we reset the move, and we still couldn't manage to break out and break through and break above the highest of the Globex range, which happens to be the previous week's high. We're flirting with a significant pivot point. So if we didn't know what was going on and you happen to have seen this low volume print, this 79, you'd want to be concerned and start hunting around trying to find why the volume is so low. To even know to look at the volume on a morning like this, the fact that the range was so narrow would be a little bit of a heads up, right? It may not look so narrow because the expansion through the kill zone, but if we took that out and we just measured the move without that, that's a really narrow range, right? It's like an 8-point range all night, maybe 10. So not very much there. And if you were to wake up, come in and see that very narrow range in the Globex, you automatically want to start looking around and finding out why, what's going on. Is there a market around the world that didn't open? Say Asia was closed for holiday or something like that. Are they sitting out because there's news on deck? Say like European Central Bank numbers are going to come out, or something like that. That way you don't get caught off guard and get ran over, right? The one thing I hate to see is when someone says, "Oh my gosh, what just happened? There was this huge move. I didn't see it coming." Really? You didn't keep track of the news? You didn't know that there was an event at 8:30 that everybody else but you knew about? Probably don't want to be trading live if you can't figure that out, right? Stay in paper. We are above the weekly pivot, which still positions us as bullish. The kind of chew on that statement just a little bit and point out that the range above this pivot really hasn't expanded any more than it had on Monday. So the weekly pivot is down here, 42.52. We kind of set that high on Monday. We have not managed to get through it since, and it's only 50 points away. But so far it's holding pretty solid. We don't have an MDP. We managed to already tag it this morning. And we're so far holding above VWAP other than that move from the kill zone. All right, so the kill zone is between 2 and 4. You notice that this move after a rally-based drop kicked off the move through the kill zone starting right at 2 o'clock. It's not a coincidence, right? I'm telling you, the clock is one of the most powerful tools that you could use as a trader, and it's free. It's neglected. It's overlooked. Most traders don't even have any concern over what time it is throughout the trading day, but it will improve your trading immensely. just to keep your eye on the hour and the half hour. We're still dealing with this split between finance and technology. So as you can see yesterday, the KRE, regional banks, sold off at the beginning of the day, stabilized, and went sideways into lunch. Then challenged VWAP, got above it, but never really did get back to where we opened. On the other hand, technology, the NY Fang, exploded at the open, ran till lunch, set the high, never really made it back above it, but certainly didn't go back to the 5-minute open range or back to the open. So two different worlds, right? Two different markets. And if you look at cumulative tick yesterday, you had no help from this thing whatsoever. Even with an aggressive, explosive technology push or the Fangs push, we had the cumulative ticks in negative territory. So we had distribution, not accumulation. This thing was reading negative. And if you look at the advancing versus the declining issues in the NASDAQ, it started out really flat, kind of negative, and expanded nearly to 50%. That was all. Half of the NASDAQ 100 was advancing. And that's it. So it wasn't like a broad-based market rally. And from the ES side of things, the S&P, we got negative nearly half, right? This is measuring the S&P 500. 250 names were down versus up. And then we rallied, crossed over above the zero line, and managed to stay above it for the end of the day in accumulation rather than distribution, but not by much. So a tale of two different markets and still this split, right? So we were all looking for a capital rotation, that we had this anticipation that maybe technology was going to sit back and digest a little bit, let these other names come up. And instead, tech just continues to explode. It didn't hold back at all, at least through the NY Fang, right? Those major market cap names. Ten-day, 30-minute volume profile. When we're at the low, we expect to go to the high. When we're at the high, we expect to go to the low. We've been at the high now all week. We set it on Monday. We revisited it on Wednesday. And now here we are again, threatening that high. Throughout the day today, we're going to lose this lower volume down here, this lower print, unless we come all the way back down and we break 41.31, which is a significant cog line. And I gotta say, while technically it is theoretically possible for us to make a move like that, that's not on deck, right? That's not in the cards. So we never want to use words like it can't happen or it's impossible, because it's not impossible. It's absolutely possible that we do make a move like that. It's just not highly likely, right? It's not even potentially likely. But when you get into statistics and using the right language, this is possible, just not probable. So at the end of the day, we're going to lose this print down here. All of that's going to be gone, which will then bring the bottom of the volume profile up to that Friday level. And we'll have more of a classic P shape, a little bit of a B, I guess, because we do have this shallow area. It'll just be a very funky B, I suppose. But then all of next week's data will have to stay above this level. Otherwise, the profile will shrink even more if we don't manage to expand up, or if we don't manage to come back below that level. All right, and then we'll have one of the narrowest profiles that we've seen in a long time. It is worth noting that the low that we were focused on yesterday, 42.61, is still the level that we need to keep our eye on today. Although I gotta also remind that whatever we hit down here that turned the market around, it wasn't a pivot in the ES, right? It was actually a pivot somewhere else. All right, marking out the 5x5. We don't have anything to carry forward from yesterday, at least not the way that I do it. That's SPY. Hold up a minute. Hold up. There we go. So we are getting a little bit of breakout expansion here. As I'm talking, maybe we'll get a little challenge. When it comes to the volume profile set up on a day-to-day, like I have it set up here, there is a school of wisdom that says you can carry forward these value area highs and lows from the previous day. I personally don't do that. I've got enough pivots. I don't need any more. So for me, I just don't. But that doesn't mean that I'm right and they're wrong. It's just not what I do. But you certainly could, and it has merit to it. There's been a lot of studies done on the volume profiles and carrying forward point of control and the value area high and value area low. There is value in it, and there is a precedent for doing it. I've just personally, I don't do it. There's not much of a profile left to work on for yesterday anyways. So we're getting really close to that 4,300, and we could challenge another 4,303 again. The markets had plenty of time to adjust after that explosive move from a little more than a week ago. So we stayed digesting all of last week. Or through this past week, I guess we could say it that way. Really tight, narrow range. Remember when last Friday we were looking at the current week's expansion, and we were talking about how this new week was a lot more constricted. It wasn't so expanded and broad as it was the previous week. And that was due to the market reading a lower volatility, right? Less of a threat, less hedging had been coming in, and the market just wasn't anticipating or projecting that a big move was possible this week. And so far, they've been right. We've easily stayed inside the lines, and we've really been hugging that Friday close. In fact, we hit it again this morning, right? That Friday close. But we do have a little bit of a megaphone pattern here, especially on the downside, right? That downside slope is certainly easier to identify. So when it comes to these ranges, the megaphone, whether it's a clean, easily identified megaphone or not, really just comes down to the idea that little by little, things get a little more sloppy, and we break the range just a little bit more on each side until finally something breaks. It doesn't have to be a downside break. There's no promise of direction. It's just that at some point, we're finally going to break this and go. But you got to be careful, because you'll get these wick out plays like we've had earlier this week, where we wick out of the range and come back in, wick out of the range and come back in. Those are just bear traps along the bottom, or bull traps across the top. They're designed to lure you in, convince you that we're finally breaking out, and then flip around and make you puke the position up and get a rip in the other direction. If we do break down, we've got a long ways to fall. We got plenty of room, so you don't have to jump in immediately trying to sell from the lows. If you think we're going to go down, sell into strength, sell across these highs. Same thing with a breakout to the upside. If we do break out to the upside, 44 is on deck. That sounds wild, doesn't it? 4,400. So we got plenty of room. There's all kinds of room to the upside. There's no reason to jump in as soon as we break out of the top. If you really want to take a long in that sort of play, take it from the lows, right? Buy into weakness. Otherwise, you got to let it break out, maybe pull back to confirm, and then join the long. Same thing with the downside. Let it break out, let it pull back and confirm, and then join the short. Then you're joining selling into selling and buying into buying with some conviction behind it. I've had enough people asking for this watch list that I put together a video on it. First of all, on Thinkorswim, when you share a watch list, the columns that you have in your watch list doesn't get shared. So people would say, hey, can I have your watch list? Of course, yes. Mine is yours, you can have it. But when I share my watch list, all you get are the symbols. You don't get any of these indicators because Thinkorswim, that's just the way it works. So yesterday I made a video and I explain what each of these columns are. And then in that video description, I shared all of these indicators, which is what they are, right? Watch list columns on Thinkorswim are actually just indicators. So you'll find those in the YouTube description under all of the morning briefing videos from this day going forward. I might have put it in yesterday's, maybe, but certainly it's in today's. So there's only two that I wasn't allowed to share, and that's because they're not public and I didn't make them and I don't have permission to share them. So I didn't share the squeeze. So the cool thing is from this day going forward, you'll be able to set your watch list columns to look maybe a little bit more like this. All right, nat gas is down 2.5%. Bonds are down 0.5%. That's the downside, and for the upside, I don't like messing with this triple leveraged stuff. Beyond that, we've got consumer discretionary, which is Tesla. Tesla is the biggest weight inside that thing. And that's it. Everything else is less than 0.5%. So no real help there. We'll take it over to TradingView. We've only got 8% of the S&P up 0.5%. And we've got 15% of the NASDAQ up 0.5%. That's not overly bullish. The thing is, if we tried to flip it in the other direction and see how much of the market is negative, we're also going to get very low or no numbers, right? It's just a very quiet market, a market sitting and waiting. It is interesting to see that some of the names that are down at least 0.5% this morning are FANG names. Amazon, Meta, those continue to be on the opposite side of everything that's going on in the market. It seems like if everybody's running, they're down. If everybody's down, they're up. All right, so we are seeing a little bit of a change here. This is weighted versus unweighted S&P. And when it's going down, it's showing that SPY, the unweighted, RSP and SPY combined. When it's going up, RSP is doing better. When it's going down, SPY is doing better. We've been going down since right about the start of the new year, right? And think about when everything just kind of flipped over and tech ran wild and just was dominating everything. That changed a little bit in March, where we paused and kind of stabilized, and it's changing just a little bit here. But the thing is, we've already started to fade back off of this candle again. For the monsters of tech, we got this little homemade indicator or a homemade chart. It's where I just combined every monster of tech into one single symbol, basically making my own index. That way we can look at it in the pre-market, which is something that we can't do with NY Fang, right? We can't look at NY Fang in the pre-market. It just doesn't work. So with this, we can see that we got a slight gap up this morning after that doji day of yesterday. Just to kind of compare what we were just looking at with the real NY Fang, this is the real NY Fang instead of my little homemade. Not too bad, right? They look just about the same. So it's pretty cool that mine works in the pre-market and theirs doesn't. Right. So the K-Web, the China ADRs and all of that, basically flat. We're not getting anything out of those. The financials aren't looking good. But they're down 8 pennies. So, not enough to really get too excited over. All right, so those bonds were defended. They did a pretty good job. We had a nice expansion back up. The thing is, it's that 50% level that matters, right? So if we come in and we measure 50% of that red bar, we needed to get above it and then we needed to keep it. Well, we got above the 50%, but now this morning we're already fading back down below it, right? So we didn't keep it. That's a really big deal because it kind of sets us up for this idea that we're going to fade back down and retest these lows. So one thing at a time, 126.11. We really want to keep our eye on that, or just call it 126 flat, because that'll kind of take care of this wick. This again shows their lack of ability to maintain this defense, right? It is a little worrisome. All right, US dollar China continues this expansion inside day breakout. It's pulling back a little bit off the wick, but it's still looking pretty good. If we look at it on the daily, we're just riding that 10. I mean, this is a ride the 9 picture, really textbook. 9, 10, doesn't matter. The same difference. So we had a little reset. Nice bounce. Now we got to get above that 7.16. It's not in critical territory yet, but that is a significant expansion. US dollar Japan still kind of stalled out, but has the same pullback and then attempt at recovery. The thing is that 50% level matters here just as much as it does anywhere else, right? So we mark 50% on that red candle, and we need to get back above that 50% mark. If we don't, then we're very likely going to retest that 20 and break down. One thing at a time though, right? These are daily and weekly charts that we're looking at, so it's not like everything's going to unfold in a single day. At least, you know, we kind of hope it doesn't unfold in a single day. All right, and over in Europe, inside day breakout to the downside and nearly no wick down there. It's still driving lower. It's 1 o'clock in London, so there's still plenty of market time left for them to drive this lower. I'd be looking for a half back at least. If we get a half back, then we've got this oddly shaped inverse head and shoulders sitting in the middle of this zone or range, kind of where it doesn't belong. But for right now, I would just focus on getting back above this pivot point and maybe pulling back off of the lows a little bit, so we end up with a candle with a wick kind of like that, right? So it doesn't leave it so exposed. All right, the dollar broke everything yesterday, broke the 10, broke the 20. We do have the 50 down below, and the 200 has been and continues to be sideways right now, so no real help out of that one. So you want to keep your eye on that 50 daily. That would be the 10 weekly. And or just around number the 103. That's not a critical level yet. We could certainly see the dollar continue to fade, get down back into that 101 area, and even back down to these lows on the year. So as long as we're maintaining above 100, it should be okay. We don't have any expectation of, drastic markets at this point. But that was a pretty solid run. Really, one of the worst things, or one of the things that you really don't want to see and that should get your attention, isn't necessarily whether it's going up or whether it's going down on a day-to-day basis. It's how fast it's moving, right? A drastic, extreme move, really fast, one time framing, single candle push, no pullback, no one taking the other side of the trade. That's when things can get a little out of control. So we still have the 10 and the 20 week. We're still maintaining reasonable market structure on the weekly chart. Nothing is broken or extreme at this point. These moves, as much as it seems a little out of control, they're not breaking anything at this point. All right, Tesla's nearly at 250 this morning, or it got there and pulled back. And of course, there's going to be saying, should we short it? is this a good place to short it? And then there's going to be somebody saying, oh my gosh, I got to buy this. I'm missing out. I don't think you want to do either one of those two things. If you try to buy this, you're buying it from the highs. And what's that old saying? Last in is first out. So you're not really in a good spot to try to buy at this level. Remember, the daily chart isn't even reflecting where price is. Price is actually all the way up here. So we are getting close to a gap. The bottom of the gap is 254 and the top of the gap is 265. We are above all the major moving averages, so you don't have anything like that to worry about. And when it comes to trying to do any sort of technical analysis, we don't do analysis on a parabolic market. That's something that you'll pick up watching things like stockcharts.com, IBD. You get it from, reading a couple books, say like Grimes, that when a market goes parabolic, it's actually doing something that it doesn't normally do. And technical analysis is designed to recognize a thing or a situation or a pattern that we've seen before, right? Because markets will behave the same way like they did cup and handles, head and shoulders, flags, tweezer bottoms. So when it starts to go parabolic and do something crazy, it's stepping out of the norm. So you can't look for normalcy in a market that's not acting normal. So is it a buy at 250? I wouldn't. Missing it and watching it run all the way to 300 wouldn't bother me a bit. If you did want to play it, say with options, on the expectation that it's just going to continue to rip, then you could buy some out of the money option. And if it does continue to rip, that out of the money option will monetize, right? It will get in the money. And so it would monetize. The thing is, those options are going to be so expensive that anything you try to pick is going to be expensive, right? It's expensive from the idea that we have no reason to buy it. You're basically just gambling or speculating. They wouldn't be so expensive if we were buying it because we had a good reason to buy it. So these aren't even accurate prices because the market's not open, but another 100 points higher from 250 to 350, we're looking at around $1. That's not too bad, but you would need Tesla to literally run another 100 points higher in the next 42 days, or at least make some attempt at moving that much farther. So I don't recommend buying a call for a swing here. You could put on a butterfly, which would be one of the cheapest ways to play it. And or maybe some out of the money spread or an at the money spread. This at least is a 1-to-1. When the market is open, it should be a 1-to-1. So it'll be pricing it at about $2.50 for a $5 spread. The worst that you could lose is 250 and the most that you could make is 250. If it continued to rip, you would be able to roll that trade, get risk out, and then you would have yourself a reasonably decent position. What I stress that you probably don't want to do is sell a put spread underneath this market, thinking that you're safe or that you can get far enough away. If this decides to fall fast or fall, it can fall very fast. I wouldn't try to sell a call spread or a put spread. Tom Sosnoff tried that on Tesla and Apple, and it didn't work out too good for him, right? It's the aggressive contrarian trade strategy. They went all around the United States doing webinars on it and teaching it and like having these big conversations about it. And the idea is that if a market has run very far, very fast, that you should just take the other side and go against it. And statistically, that's true. That's the way it goes. But that doesn't mean every time it's going to work, right? It just means most of the time it's going to work. Another way that you could play Tesla, by the way, is just to play the ETF. Oops, that's Staples. Play the XLY, consumer discretionary, which makes up, or which is made up of a lot of Tesla. Tesla makes up 17% of the XLY. And Amazon makes up 25%. So between those two, you're looking at a heavy weighting from the FANG names inside the XLY. And Amazon's still doing pretty good. Down today, but all right, so 50% mark. We are on a daily with Amazon, and in the pre-market this morning, we faded down to 123.75-ish. So we're really just down a little bit, just right underneath this 50% mark. We need to see it either complete the move and get above, or this is going to be the rejection point today, and we're going to continue that rollover, come back down to retest that 120. It does have us primed up pretty good in Amazon. For you newer traders, maybe a little slow to the game, right? Where you're not where you're hesitant, right? Let's say it that way, where you're a little cautious about taking a trade. If we're sitting right about here this morning, it's not quite in the middle of that candle from yesterday, but it's close enough. You could look for a breakdown, or you could look for a breakout. If you wanted to narrow that up a little bit, you could look for a breakout above yesterday's close or a breakdown below yesterday's open, rather than waiting for it to get all the way outside of the previous day completely. I like an inside day breakout, right? I like starting inside the previous day and then working our way out an inside day breakout. I like it that way, but to each their own, right? All right, Apple's up just a little bit this morning, 180.75 when it closed at 180.57. It's still inside day at this point, but not by very much, right? It's very close to breaking out this morning. Apple's got a really nice setup, especially after this bullish run was paused and we had this gentle fade. This is a really ugly TRB setup, a very ugly TRB. So you got two ways to play it. The slower way for you more cautious players, that would be waiting for it to get above that candle, or waiting for it to bounce off of the close of yesterday. So a nice little pullback at the open. We bounce off that level and we run. That's 181.18, by the way. It's from the 7th, so 2 days ago. $181.21. So really nice setup in Apple. It's a easy to follow, easy to trade kind of play. We want to pull back and bounce. And if we don't get that, because sometimes, a market just gaps up and then continues to go at the open, then look for that breakout above 180.84 first, and then 181.20. If this turns out to be a continuation of yesterday, which will be a little bit of a surprise for those people who don't think you can get 2 big days in a row, they're already going to be trying to short this. Those shorts are going to have to buy to close. It's going to add to the "oh dang, I was wrong" group. A little bit of a surprise as well. Markets don't like to be surprised. This could easily get back up to 185 today. That's not a big move for Apple. So don't feel like you got to get into this thing as soon as it gets to 181.21. You got plenty of room. I'm very likely going to be pricing a butterfly at that 185. I might put it through a couple of different expirations. Obviously, I don't want a 0-day. But I mean, I say that, but if it can price nicely enough. What is a butterfly? Now remember, the market's not open, so this is not going to be perfectly accurate, but would you be willing to risk $20, 20 cents on a butterfly that might pay you somewhere in the neighborhood of, make sure I don't have anything else in here. Yeah, that's what I thought. So you're risking $16 with the potential to make 175. Max is 220, but we never look at max, right? Because max is like a lottery, winning the mega market lottery. You don't want to aim for that. But even aiming for just 1/4 of that or half, $100. For you to have a winner in this trade, Apple would have to get up between 183 and 187. That's not a bad window there. $4 window for you to see some sort of profit. And it would need the move today, right? That's a 0-day trade. You'd have to be out of it by the end of the day. If you start getting any of those legs in the money, you would need to get out of it. So Meta's down a little bit this morning. They closed at 264.5 and they're at 263. So a little bit of weakness. It's inside day and fading down a little right about here. So it's at the low of the 7th. That kind of primes us up like that other trade we were talking about, where all you got to do is wait for an expansion one direction or another. And the more aggressive trader could get in as soon as it gets through the close or as soon as it gets through the open of the previous day. If you want to wait and be a little more cautious, then you could wait for it to actually break completely out of the previous day. The kind of move that you're looking for is like that, right? Where we close here and we opened it here and we fell down and broke the previous day's low, and then we expanded nicely to the downside. We could very easily get that same move today, or we could rally, break out, and retest. And look at all the sellers that are sitting up here We don't know that they're done yet, but it's very likely that they're not done yet. So if we do get back up there, we're just going to get selling again. That might not be a bad place to put on a call credit spread. Join the sellers on that. I don't think you would get any money out of it for a 0 day, so I wouldn't even bother with that. But say going out a little ways, $275 area. Crazy cheap butterfly. $0.13. Of course, the market's not open. That could be a little cheaper, or it could be a little more expensive, but that means you can widen it out, right? I went with 275 with a 2.5 point spread, but we could make it a $5 spread and it's 50 cents. Now, the thing about doing this is I just priced a butterfly, but you would want to actually price a call credit spread and then later add the call debit spread, right, at a later time. And then you'd have this butterfly with a really great price rather than getting it right now. Call it legging in. All right, everybody, that's what I've got. Be careful, be safe, keep your eye on the news. I wouldn't short this market, right? That's the long and the short of it. Don't short it just because you think it's gone too far. Not Meta, but the market. And as much as they're talking about it's a bull market, blah, blah, blah. Yeah, okay. That we'll just have to do a video on it at some point, right? And talk about safe ways to play the trade. I'll see y'all next week.